Every single working Australian is about to see a change in their pay packet, and most people have no idea it's coming. From the 1st of July 2026, income tax rates are shifting. Superannuation rules are being rewritten. HECS repayments are calculated completely differently, and there's a brand new deduction worth claiming even if no receipts were kept. Some of these changes put money back in the bank. Others quietly cost more. By the end of this video, exactly which category applies will be clear and what to actually do about it. Let's start with the headline change because it affects almost everyone. The second tax bracket, the one covering income between $18,201 and $45,000, is dropping from 16% down to 15%. It doesn't sound dramatic, but for anyone earning $45,000 or more, that's an extra $268 a year, delivered automatically through updated pay-as-you-go withholding tables. No forms, no applications, just slightly more take-home pay from the very first payslip of the new financial year. And this isn't a one-off. It's round 4 of 5 legislated tax cuts stretching back years. The next reduction is already locked in for the 1st of July 2027, when that same bracket falls again, this time to 14%, doubling the saving to $536 annually. Stack these changes together, and the average Australian earner on roughly $81,000 is looking at close to $2,500 a year in cumulative tax relief by 2027, compared to where rates sat back in 2024. That's not pocket change. That's a genuine shift in take-home pay over time. Now here's something brand new, and it's going to save millions of people the annual headache of hunting for receipts. Starting the 1st of July 2026, a standard $1,000 instant deduction becomes available for work-related expenses with zero substantiation required. No shoebox of receipts, no spreadsheet of laundry costs, no scrambling in June. Around 6.2 million workers are expected to benefit, with an average saving of $205. But here's the important clarification nobody's making clear enough. This doesn't replace the existing system. If actual work-related expenses run higher than $1,000, the full amount can still be claimed the old way, provided the records exist to back it up. And separately claimable items, union fees, income protection premiums, investment-related expenses, remain entirely unaffected by this new flat deduction. Think of it as a safety net for people with modest work expenses, not a replacement for genuine record-keeping. Moving to superannuation, because this is where the changes get structural rather than just numerical. Payday Super has arrived. Employers are now required to pay superannuation guarantee contributions at the same time as wages within 7 business days, closing the old quarterly payment gap for good. Why does this matter so much? Compounding. Money that used to sit outside a super account for up to 3 months is now working inside it almost immediately. Across a working lifetime, that head start adds up to meaningfully more retirement savings purely from timing. The superannuation guarantee rate itself holds steady at 12% for the 2026 to 2027 financial year, no further increase this round. But the contribution caps are rising. The concessional cap, covering employer contributions and salary sacrificed amounts, lifts from $30,000 to $32,500. And the non-concessional cap for after-tax contributions increases from $120,000 to $130,000. For anyone with room to contribute more, especially closer to retirement, this widens the runway considerably. Now, for the millions of Australians carrying a HECS or HELP debt, this next change might be the most consequential of all. The entire repayment system has moved to a marginal model, replacing the old flat rate approach that used to punish people for earning just $1 over a threshold. Under the old system, crossing a line meant a percentage applied to the entire income. Under the new marginal system, Only the income above the threshold gets taxed for repayment purposes, exactly like how income tax brackets already work. That single change eliminates the notorious cliff effect that used to discourage overtime, bonuses, and pay rises. For the 2026 to 2027 year, the minimum repayment threshold sits at $69,528. Earn below that, no compulsory repayment at all. Earn above it, 15 cents per dollar applies above the threshold, scaling upward through higher income bands. And it's worth remembering this sits on top of the 20% reduction already applied to existing HELP balances back in June 2025. Between the debt cut and the fairer repayment structure, this is genuinely one of the biggest wins for graduates and young professionals in years. Here's one more shift that could influence a major household decision. The Medicare Levy Surcharge thresholds are increasing. Singles now avoid the surcharge until income exceeds $105,000, while families get breathing room up to $210,000 combined. For anyone sitting just above the old thresholds, this could mean a genuine escape from the surcharge entirely, potentially saving over $1,000 a year. Worth pairing with a serious look at whether existing private health cover still makes financial sense, or whether it was only ever held to dodge a surcharge that no longer applies. On the wages front, the Fair Work Commission has delivered a 4.75% increase to minimum award wages from the 1st of July 2026. The new base rate lifts to $26.44 per hour, or $1,004.90 per week. Entry-level rates climb by close to 6%. In total, roughly 2.8 million Australians are directly affected by this decision, a meaningful cost of living measure landing right alongside the tax and super changes. Now, looking further ahead, because smart planning happens before deadlines arrive, not after. From 2027, negative gearing rules tighten for established investment properties purchased after budget night, while new build purchases remain unaffected, and anything bought before that date is grandfathered under the old rules. Alongside this, capital gains tax is being restructured. The long-standing 50% discount is being replaced with an inflation-based discount, plus a new 30% minimum tax rate applying specifically to gains realized after July 2027. Existing new build investors will get a choice between the old system and the new one. These are 2027 changes, but decisions made this year about property purchases could easily be affected by rules that don't even take effect for another 12 months. For small business owners, there's genuinely good news. The $20,000 instant asset write-off has been made permanent for businesses with turnover under $10 million. No more waiting each year to see whether it gets extended. And loss carryback has returned, allowing this year's loss to be offset against tax already paid in the prior 2 years, potentially generating a welcome refund for businesses navigating a tougher trading period. So, pulling all of this together, some of these changes put money back in pockets automatically. Others require a bit of homework to actually capture the benefit. And a few, particularly the 2027 property and capital gains reforms, demand planning well before they even take effect. The real advantage doesn't come from knowing that changes exist, it comes from knowing exactly how they apply to an individual situation. Review tax withholding once the new financial year begins. Check whether extra superannuation contributions make sense given the higher caps. Look up the current HECS balance and repayment rate on MyGov. And for anything involving property, capital gains, or a genuinely complex financial position, a conversation with a registered tax professional is worth far more than any general overview ever could be. If this helped make sense of a genuinely complicated set of reforms, hitting like helps this reach more people who need it. Subscribing means the next update lands automatically, and turning on notifications means nothing important gets missed when the 2027 changes get closer.